Hello, folks. Brandon Chapman with you today. It's February 24th, 2019. It's a TheoTrade video, and we're talking the S&P. If you have the question of, are we there yet in terms of a near-term market low, we're going to profile what a market bottom looks like. So last week I talked about conditions that triggered on February 14th that suggested the S&P might decline 5 to 10% in the next 30 days. Now, during my daily session on Tuesday, I walked through how to hedge a portfolio and how to take a position in the VIX in case we move north of 20. Now, we did touch 20 today on the VIX, backed off it. We're still about 30 minutes before the market close. Anything can happen, but obviously today's today, and we got tomorrow, the next day, and the next day. Are we there yet? Are we near a market low? Now, here's the deal. Most people right now are just starting to say, hey, I've got to back off. Well, why? Why are you backing off right now? Because they got slapped on the hand on Friday, right? They tried to put their hand in the cookie jar, pull out those profits, and all of a sudden they got slammed on Friday. Why? They didn't preemptively look to take profits into strength. They waited for the market to decline. And I've used this stat before. This was from the 8% correction in 2024 back here in the July timeframe. Well, if you go back to that point in time, the S&P lost 8%, the NASDAQ lost 13%. But guess what the average NASDAQ stock lost during that phase? It was 46%. The reality is most people are taking more risk than they really realize by virtue of the stocks that they're trading. And so all of a sudden, the market catches a cold, the S&P has a routine 5 to 10% correction, but you're feeling the devastation of your portfolio losing 50%. So the idea is trying to anticipate these kinds of moves, and it's not that hard necessarily, right? You can look at the volatility markets both from a perspective of increased hedging and all of a sudden the flip side, looking for near-term bottoms and trying to shift that mindset from saying, oh, I got to pull back now, taking losses, and waiting for the market to test new highs after these kinds of pullbacks. Again, it can become costly. You sit on your hands too long, you're waiting around. But the reality is, following the hedging strategies I talked last week during my session, you've taken profits, you have 30% cash, you've hedged another third, you've taken on a volatility trade or hedge using the VIX, you're really prepared for just about anything. So what that does, it takes the VEX off, right? It takes the issues of, oh, what's the market going to do? You've already prepared for it because you've taken the VEX off of a big downside move to 5,800, which is a 5% move, or 5,500. And this is what I talked about in the video last Wednesday, subbing in for Dawn. And so now it's all of a sudden say, hey, I'm ready for the downside. Now I need to get ready for the upside. And that's why it's so important to be able to look at the market and say, hey, I'm realizing when I need to start to change my mindset. And so again, back on the 14th, where were you? Right there. You had a very significant signal that, hey, again, I talked about last Wednesday, 5 to 10% correction in the next 30 days. Whether we get a 5%, 10%, 20%, 30%, or we only pull back 2 to 3%. It doesn't matter. You're prepared for anything. Now it's about getting ready. And let's just see how much we pulled back off the highs here. We're down nearly 3%. But you're prepared for any type of result because we sold calls up here. We bought puts down here. We have a VIX hedge. Everything's in tow. We're ready for any downside. And at the SPY, I talked about it in my session today. If the SPY gets down here below 599, which is 596 earlier today, 595, we're going to roll that put hedge further out of the money, back down to a 30 delta with current expiration, maybe more. So we'll see where this finishes today. And as we look at the VIX vol spread, we're looking for something a little north of 20 up here to close this out. And specifically, I'm looking at a ratio of 3-month to 1-month volatility. And when I talk about are we there yet, this is a key indicator for determining that. And what I want is a ratio of the two. So I'm going to bring up something called a pairs ratio study. Unfortunately, they used mathematical operators like the division sign for future symbols like CL. So you can't use them for just plugging in a symbol here. So you got to create a composite symbol And then you need to bring up the pairs ratio study, which I have here. It's just customized by color and width. So I really don't care about the candles. That's just the composite line. What I want to see is this. We were stretched up here, right? That's Valentine's Day, right? The 3-month vol VIX was 20% higher than the spot VIX, 30-day VIX. We're looking for that to come back in and snap. When that happens, it's at 1. And we're looking for the VIX to move ahead of or above the 3-month VIX. So right here, that gets below 1. That's a trigger for closing out what we talked about on Tuesday during my session, the VIX vol spread. What we did was we bought a March 18th. We bought the 16 and sold the 20. Now, right now, that spread's up about 33%. But when we were pushing up here earlier, it was up close to 70%, which is getting in that target range for this type of trade. But really what I want to see ideally is for the 3-month VIX to go below the 1-month VIX and this line to get below 1. Now, you could use something like VIX backwardation as well. Product depth here, VIX. We'll notice right now, earlier today, this line was pretty flat. It's now upward sloping. What I want to see is this in backwardation. I want to see this futures line, at least these two contracts here, I want to see them declining. And that gives us a signal that the market's pricing in lower volatility in the future, and maybe close to 80% of the time, that's a near-term low in the market just by seeing that. Normally, those are your 5 to 10% correction moments. You go down 20 plus, and this can stay in backwardation for a while, and this can really go deep in here and stay down for a while. But again, we're talking about hedging, right? The idea is if you have a VIX volatility spread in tow as a trade, we're not waiting because the VIX itself doesn't trend. The VIX always mean reverts, right? It always comes back. Maybe it's 15, maybe it's 13, maybe it's 12, maybe it's 10. Okay, the average on the VIX is around 20, 19, 20. If you go back, Don talked about this morning during his session. Average is 20, right? We're just getting to average. Let's see if we overshoot, but it's going to come back to 20. It's going to go below 20. And so these have a limited shelf life. And once you've seen the show, the reactions become smaller and smaller. Now, this one might be more unexpected, right? With all the stuff that's going on. Or after this event back here, that was on December 18th, we'll count forward, right? We're about 1-2 months into it right now. So normally I look for about a 3-month window to get outside of to see the VIX potentially return to other levels. But Friday, there's a big trade on the VIX buying a 36 and selling a 75. Now, obviously, someone's out there. If you're buying a 36 and selling a 75, it was like well over 30,000 contracts. But what's happening when you see that, they're just saying, hey, just in case things go really crazy, I'm ready, right? And that's the big thing you have to remember. It's being ready for the correction, right? It's not about calling it every time because you're not going to be able to do that. But a 5 to 10% pullback, there are very specific signals. Again, I walked through it last Wednesday. Now, we talked about one signal or two signals here, VIX and backwardation. We talked about the 3-month VIX dropping below the 30-day VIX. What would you want to see from the S&P 500 to identify these kind of near-term lows? Well, I like to look for this. I've looked at a lot of different methodologies, and I really like the ATR. And you'll see the daily ATR is about 62.79. You see right there, right? See this over here. 62.63. Right now, we're only down 5. Okay? But if we were down 62 or 63 today, like we were on Friday, by the way, but again, Friday didn't achieve the results we're looking for. The VIX didn't go up high enough. Today, we came close to that, but didn't materialize, and we didn't finish down more than 62. We're only down 6 right now. We could readily fade with 20 minutes left. So again, we got to keep an eye on, okay, where's it going? We could sell off into the close if people just don't want to carry the risk overnight. But the reality is we're not down 62. If we look at the VIX just by itself, I like to apply a 20-day 2ATR Keltner channel. I call it the Keltner trend here. I use it for stocks as well. We came close to triggering. I want to see the VIX north of, in this case, 20.5 today on a closing basis. You'll see it back here, for example, on the 18th. Intraday, we popped through it right here on the 27th, almost opened at it and then fell back. I want to see this breakthrough. Again, close above, in this case, 20 is going to get a little higher tomorrow if VIX rises. So we got to see the VIX close near a high above the 2 Keltner channel. So when I talk about 4 indications, what are they? The ATR. We got to be down more than 1 ATR. We got to see the VIX close above the upper Keltner channel. We want to see the 3-month VIX drop below the 30-day VIX. We want to see the VIX futures in backwardation. All of those things signal what? Capitulation in the equity markets, extreme hedging by driving up the VIX, by buying puts, and the others, again, looking at the 3-month and 1-month VIX, the VIX futures, the market's pricing in now lower volatility in the next 30 days instead of higher volatility. And those are the conditions we want to see. Are we there yet? The answer is no, not quite. We came very close today, but the reality is you don't bottom in the S&P just on a whimpering down day like today. You want to finish at lows. And Friday was like one of those days, but guess what? When we're down on Friday, Mondays, I think over 90% of the time are down as well. And it looks like we're going to finish there today. And so as we consider the market currently, we've got to switch our mindset, right? We had the indication back here. We needed to do something, take profits and hedge. Now, because we're ready for anything, we can now put our bullish hats on and say, okay, when are we there? When can we start to look more bullishly on the market? And now you've got 4 indicators that help tell you when we're looking to achieve that, and you're going to start to look for bullish opportunities. Well, I'm going to give you 2 different trades that happened today in the options market. I call them option pulses, okay? And these are designed to what? Basically to say what's going on behind the scenes. Is there an opportunity? Well, guess what? Definitely, I mean, staples are pushing, healthcare is moving higher today, financials are moving higher. There is no correlated selling today, which tells us we're not at a low. So, but staples are hanging out so far, doing well, and a lot of those stocks are doing well as well. If we start to see correlated selling, what's going to happen is even staples are going to sell. But the reality is there may be areas or pockets of strength and maybe individual stocks. One of the areas of staple I've been looking at is in AllTrade, right? I'm getting distracted right now, but let's take a look at what the one that's developing. One is CMG. Now, CMG is down 0.73% today, and we broke out bearishly. So how in the world can I be bullish on CMG? Well, first off, we had a very significant trigger last week. Yes, selling can be a bullish trigger. That it's going to take selling in the S&P for us to get a bullish trigger there, right? Same as CMG. Well, if you look at these lines, this is called an expected move. Every Friday before the next week, you have the expected move. This is called the expected move indicator. It's Don's proprietary indicator. Okay? He's programmed it. It's in here, and I'm showing it to you right now. And if I go up to studies, I can alter this. It's my variation of it. That's one of our clients made this for me, which I appreciate greatly. I'm going to make the EM multiplier 3. And something rather significant happened last week. We broke below 3 times the expected move. Basically, you take the range that the market was pricing in, and we blew through it to the downside. Frequently, what happens when you see this, we start to get very oversold in the near term, and all we're looking for, we're not looking for some massive rally. We're just looking for a little snapback. Okay, we're not going to hit 3 times the expected. Could we? Sure. But all we're looking for is a little bit of a bounce in CMG here in the near term. And guess what? Doesn't have to happen today or tomorrow. We may even drift and then get a pop and you're done. Okay? So with this trade today, we come out here to a April expiration, and right here, 24,000 contracts, mostly bought at the 55 strike. Now, there's probably been some trade, but early on in the session, I'm going to go more info here. We're going to look at the chart specifically, and what you're going to identify or see here in the chart is something called a gamma squeeze. So I got to minimize this left-hand side. So we're going to go here to indicators to remove these indicators, and we're going to go intraday. Now, what happened early in the session, you look right there, okay? And you notice right here, we had what? We had about 2,400 contracts coming through there, another 10,800 there. And again, we're talking about what? Over 13,000 contracts traded in what? 2 minutes. Well, look what happened to the price when shooting up here on accelerating volume at almost 100,000 shares in that minute. This is a what? A gamma squeeze. Okay. And what we're looking at in CMG is, all right, we're really oversold. Somebody's stepping in and buying calls today. Again, is that for certain that the stock's going to rally? No. But if we start to break through here, we get what's called a gamma squeeze and could really drive the stock as those calls that are being bought. Market makers are taking the other side of it. They've got a hedge with long stock. It's why you saw a big pop in the stock on volume. Yes, we faded. We started to turn around, maybe a trade through today's high, for example, and we could see it pushed. But the great thing about this is that if you trade a spread, well, guess what? If you go out here to April, you can buy it's kind of, it hasn't been, it's not as good as it was earlier today. That was loud. That was lower. That was higher. It's pricing a little bit better, but 50, 55, right? You could buy 50, sell at 55. We're just looking for a little bit of a bounce towards 55, and you're probably out at a 30 to 55% return. If we can just get a move up into this area, we don't have to go back to prior highs. That's the advantage of this trade here right now. So again, that's one idea. Another is KWeb. Now, for those that have been in my sessions, you know that I was really bullish on BABA back here on January 8th. It was one of my value stocks, magic formula stocks. Again, we saw a lot of kind of stuff, kind of option activity kind of centering around that day. Good valuation area, expecting a little bit of a rebound in BABA and Chinese stocks generally. I was looking at a 61. If we break that, we're going to 118. And I talked about, sent an announcement out to sell it here for a 35% gain on the 11th in our announcement section of our daily chat. So what my point was, it's not that it can't go higher. It's just we start to get above this level, the volatility and the risk expand. Stocks down 10% today. Well, all of a sudden, KWeb, right? So I talked last week about Friday. How do you speculate on Chinese stocks? If you're going to take a stab at it, it's getting increasingly more risky to want to own the equity. How do you use options in this circumstance? Well, on KWeb today, some significant trade on this stock, a couple of them here for the April and 7 March. So on 7 March here, we scroll down. You can kind of see right here at the 36 strike, 8,300 contracts against 1,000. Most of that being bought. Back this out to April 17. The April 17 monthly expiration. You can see again right here, 36 at 31,000. You got here 41. You got 38 in here. But again, if we look at the 36, the 36 and the 41s, and how can you see that? Just come down here to time and sales, option time and sales, and we'll kind of zero in on right here. You see 28 and 28. All this is looking at here, where is it kind of filling in reference to the market? You're just not going to see short call verticals like this, right? It's likely this is a long call vertical, just filled near the bid, got improved pricing on it. So we're just kind of reflecting it here. And again, buying the 36, selling the 40. Well, again, buying the 36, selling the 40. Why is this advantageous rather than buying stock? Because if you look here at 17 April, again, we're looking at the volatility. Volatility is rising. What does that mean? You can buy the lower strike and sell the higher strike. So again, you look at the 36. Well, guess what? This happens to be around a 40 delta, right? Well, you could buy a $2 wide spread, just kind of walk through a trade. Just kind of a trade, just pricing here. 2 strike vertical. Its pricing is 60 cents. You risk 60 to make $1.40. Reality is you're looking to make, if you could sell this for about $1.05, you're done, right? Try to make about 70% on that. If we just pop up here to 38, even like 37-ish, you're probably done with that spread. We're just looking for a near-term bounce. Again, I don't really like China. Why? Because they've been expanding their money supply greatly, and we're going to start to see probably soon some devaluation in the Chinese yuan relative to the dollar, and it's the exact same thing that busted it back here, right? So we're in similar territory today as we were back here. Another time I was bullish, another time I was bullish right here. Again, bullish down here. We start to get towards the apex up here. This is where the risk accelerates, increases, but there's ways to play it. There's ways not to play it. Holding equity and seeing 6% moves in a day are tough. We could be down another 10 tomorrow. Who knows, right? When is the revaluation going to take hold? I have no clue, but there are ways to speculate, and that's one of them, how to do it. Playing the call set spread. just ensure that you're willing to take that max loss. In lieu of a bit of a snapback, we get back to prior high, you're probably done with that spread. But again, that's how to play China. But again, they're still seeing that bullish, call option activity still kind of feeding in at this point. But it's getting increasingly risky to own equity on the Chinese side. And again, unless you have a really, really long-term view and you're weather to test 28 or 26 in the coming months, because boy, you know what? When you see these busts like this, it's big and it's hard to weather. A lot of people buy up here and sell down here. That's the buy high, sell low. We want to do the opposite. Well, folks, that's all I got for the video today. Hope you have a great one. Thank you.